Welcome back. India's Q4 GDP came in way above expectations. 6.1%. Our poll had a forecast 5.1%. This Q4 number has yanked the full year GDP growth to 7.2% against market expectation of 7%. So what went so damn right in the fourth quarter, and what does this mean for the growth in the current year in FY24? I'm joined by A. Prasanna, Chief Economist at ICICI Securities Primary Dealership, and Pranjal Bhandari, Chief India Economist at HSBC. Pranjal and Prasanna, thank you very much indeed for joining me. Prasanna, well, you first, what went right?
Yeah, so our own estimate was higher than the street. We were looking at 5.5% GDP growth. So I think the difference for us was basically on agriculture and industrial numbers. Agriculture, obviously the winter crop, or rather the winter sowing and then later the harvesting, has gone on much better than what was initially anticipated because of weather concerns. On the industrial side, again, we're looking at both IIP and manufacturing sector profitability numbers. We thought the quarter would be a bit weaker, but clearly it looks like, I think, the slowdown or deceleration in input prices means that manufacturing GVA was much higher than what we anticipated. Of course, we shouldn't discount that there could be some deflator issues involved here. But having said that, I think the general trend or the direction, it's in the right direction, that as your commodity prices and input prices soften, your manufacturing profits should, or rather the margin should expand, and that should lead to stronger GVA growth.
Okay. Well, Pranjal, similar question to you. Is it agri and manufacturing for you as well? Because construction, 10.5, trade, hotels, transport and finance, 9 point. It seems to have fired on all cylinders.
That's right. So Prasanna has already spoken about agriculture and manufacturing, but there's also construction and investment. Both of them did very well. And when you really look into the data, I think it comes really from government capex. Both state government capex and the central government capex really took off in the last quarter of the fiscal year. So I think that, created that exuberance. So as you said, across the board, but I also want to caution a little bit, Lata, here, because towards the end of March, we had some weather disruptions, unseasonal rains. And I think the impact of that on the crop will actually show up in the next quarter's data. So we need to be really guarded a little bit on that front. But yes, barring that, a good number and across the board exuberance.
Okay. Well, the number that worried me, and I guess all of you have written about it, personal final consumption coming in at just 2.8%. How much is that a worry, Pranjal?
Well, look, that is a worry, because at the end of the day, it is consumption, which, once it's high, then, firms start producing more, then capacity utilization rises, capex comes. So in a way, it's very important for capex, for consumption to do well. There could be a little bit of underestimation here, because what we have found is that in the last couple of months, it has been the informal sector that has really taken off, both in rural India and in urban India. And their consumption basket doesn't get picked up very easily by the CSO in the short run. So my sense is there could be a bit of underestimation there. I'm hoping that it gets revised up in subsequent quarters. But nevertheless, I think we need to be guarded in case this is the sign of some slowdown. Then, this does, point towards lower prints coming up in the next few quarters.
Yeah, actually, it doesn't gel with what you have said in your today's report, as well as previous reports, that the informal sector is actually doing well. So this low consumption is not tying with it, isn't it, Pranjal?
Yes, that's right. And look, I think a lot of the high frequency data we capture for informal sector is showing, good momentum. From rural wages to urban employment to finances of small companies. And my sense is that the GDP data yesterday did not really capture all of the consumption arising out of the informal sector, because a lot of their basket also is goods produced in the informal sector, and that doesn't get captured very easily by the CSO in the first round of data collection. So my sense is that will get captured a couple of quarters down the line.
Okay. So, of course, revisions are always coming in. But Prasanna, I will come back to you for consumption in a minute. But this excellent capex number of 8.9, I think it's been a few quarters when capex growth has been very good. doesn't this provide the momentum for better growth in the current year as well? Are you revising any numbers? But first, your thoughts on capex.
Yeah, so I think, like Pranjal pointed out, I think a lot of it is driven by government spending on capex, especially central government. State governments seem to have picked up, but over the year, if you see, actually, the state government capex numbers have been a bit on the disappointing side. A lot of it is driven by center, and probably that's what is driving the construction sector growth also. So I think our hope and our expectation is that the private sector capex also will pick up. I think, obviously, if you look at the manufacturing as entire manufacturing wide capacity utilization numbers, those numbers have been going up, and probably there are sectors where capacity constraints are being hit. I mean, I do think the platform is there, and we know that corporate balance sheets are in better shape. Bank balance sheets are in better shape that they can, it's possible for them to keep expanding lending. So I think the stage is set for private sector capex to also pick up. But again, like it's been pointed out, I think the visibility on final demand needs to be there. So obviously your consumption demand needs to kind of show a bit more robustness. And of course, we don't need any kind of global demand shocks coming in. I mean, a slower global growth is okay, but an outright recession, a strong, deep recession in US or in rest of the world, I think that can also upset a lot of capex plans. So I think we do need a bit of good fortune, but the platform is there for capex to kind of pick up.
Okay, yeah, so weak domestic consumption as well as likely weak global demand. But therefore, you aren't revising your FY24 number at all?
Yes, so our FY24 number was 6%. We are retaining it. What we were qualifying it earlier was we were saying there are downside risks. Now we think the risks are more balanced. So it's we don't want to revise the base case number, but the risk profile of this projection has changed. So I think we are comfortable with that. As I said, I think we're still worried on the global side, especially things, what we're hearing out of China, for example. I think there, obviously, the whole recovery or related pent-up demand that has definitely slowed down. And US, of course, I think the lagged effect of all the policy tightening will play out. So therefore, we don't want to get ahead of ourselves. I think 6% is kind of a number with which we are comfortable with. And especially because the momentum from fourth quarter should continue into the first half of this financial year. I think probably some effect of the global slowdown will come in the second half of the financial year. And we shouldn't forget, I think there is still some effects of our own monetary tightening. I don't think banks have passed on completely the rate hikes by the RBI and the MPC. I think that part will also come into play during the year. So therefore, we are sticking with 6%.
Okay, 6% is evenly balanced also because there are 5 people ahead of you and 5 people below you. So I suppose 6 is evenly balanced even with respect to the numbers we are running. But Pranjal, I'm a little surprised with 5.5. If you say informal sector is showing growth and that might be registered by the NSO in the coming years and capex is good, you don't see any reason to raise the current year forecast from 5.5. That's a distance from RBI 6.5.
Yes, I think there's been a growth relay of sorts. The informal sector has been rising, but the formal sector actually has been weakening. And there's a lot of data to track for that. You know, they are big consumers of imported consumer durables, and that number has really fallen off. When we look at the loan data, sequentially, we can see that that's also falling a little bit. You know, rates are now higher. So my sense is, generally speaking, the formal sector is getting weaker. The informal sector is getting stronger. So overall, you know, it doesn't mean that everything is gung-ho. There are parts of the economy that are getting weaker. And then there are some sort of question marks in the horizon. I think 2 big question marks are the whole El Nino. Will it lead to a drought in India? I think that's a big question mark out there. And I think the other big question mark is, how does India deal with the big fall in oil prices? Do we really cut pump prices? Because global oil prices have fallen by $20 a barrel, but we haven't really cut our domestic prices yet. So I think the range of growth from my perspective is between 5.5% to 6% for FY24. And if we can get by, and El Nino is not a big problem, if we see some cuts in domestic oil prices, my sense is we could be on the upper end of the range. But, you know, this is the range I'm working with, 5.5% to 6% growth.
Okay, so there is a slight upside in terms at least of your tone to the 5.5. Prasanna, what does all this mean to the Reserve Bank? a solidly growing economy. So we should not expect anything but a pause from the Reserve Bank, any change in stance. How do these numbers translate into policy?
Yeah, so I think there's nothing much to be said on the rate side. I think pause should be the decision, because I think inflation profile has also improved compared to, I think, what the RBI and the street had expected back during the April policy. On the stance, I think, it's between this meeting and next meeting. At some point, they have to change stance, because if you keep pausing on rates and then you keep saying it's withdrawal of accommodation, I don't think these two things are syncing well. I think this is going to lead to some communication issues also. But probably, I think what the RBI and the MPC might be looking at is that I think the Fed has not definitively signaled a pause. It's looking like they will pause in the June meeting, but subsequently they might hike in the July meeting. And of course, like you pointed out, I think growth impulses are also strong. And given that both the RBI and the MPC have been worried about core inflation pressures, I think this should give them a moment, should lead them to reconsider about becoming too dovish in their commentary. So in the sense, I think if they want to strike a balance, probably they can still retain the stance, but I think the time is running out. Maybe they have to start guiding the market. I think if the idea is to go for a long pause, that is something they have to figure out a way to craft the message that, the rate hikes are done, but we are not ready to cut also. So we are in a period of a long pause, and we kind of try to maintain monetary conditions more or less in a constant manner. I think that is something they have to kind of figure out a way of communicating that to the market. So even if there is no change in the stance officially in the statement, I do expect in terms of commentary by the governor and other officials to try to kind of guide the market towards a long pause.
Okay. We will discuss monetary policy, of course, in the next 4-5 days. But Pranjal, just a very quick observation from you. We were all complaining, or all experts were complaining about the skew in the economy after COVID in particular. And of course, the previous instance of GST and demonetization also contributed. Is that skew getting a little better, since you're saying the informal sector is doing well and the formal not so well?
Yes, I think so, Lata. I think it's getting better. Growth is becoming more equitable. Informal sector, which had been doing very poorly, has caught up, and we have a lot of various data, and all of them are pointing towards the same message. And I think that's great for macro stability. I think the growth we had right after the pandemic was led by the top of the pyramid, by formal sector. Many people in this sort of formal top of the pyramid sector are huge importers and consumers of imported goods. And that was also one of the reasons why the current account deficit, the trade deficit, had widened so much last year. So now that the growth is more equitably spread, we're also seeing some, benefits on the macro stability front. The current account deficit has narrowed substantially and all of that. So I think we're in a good place in terms of, growth becoming more equitably distributed.
Okay, on that very positive note, actually, since a long while we've heard about, inequity. So hearing about less skewed economic growth is a positive. Pranjal, Prasanna, thank you very much for joining and parsing the GDP numbers, giving us some idea of what we can expect in the current year. It's somewhat rosy. Everyone's increasing their growth forecasts, and those who haven't, like Pranjal, are on the front foot to do that, or so it seems. Wrap up on Bazaar. Chartbusters up next.